Nouriel Roubini is the chairman of Roubini Macro Associates, and he writes the following. The US remains at the centre of a technology-driven positive supply shock that raises growth and lowers inflation over time. Nouriel joins us now for more. Nouriel, good morning. Good to see you.
Great seeing you.
Fantastic to catch up with you, sir. You're bullish, not just for the year ahead, but through to 2030. Can you flesh that out for us a little bit more?
Yes, I mean, everybody's talking about AI, Gen AI, but this is only one of the 15 technologies of the future. They're all related to AI, but it's AI, semiconductor, biomedical research, quantum fusion, defense tech, fintech, new material science, you name it. And it's a race between US and China. I don't think it's a zero-sum game. US is going to do well, China is going to do well. But my estimate is that the US potential growth is estimated today to be only 1.8%, could be as high as 4% by the end of the decade. And I've done a bit of a bottom-up analysis. And by the way, the data and productivity, after the GFC, average productivity between 2009 and 19 was only 1%. Since 2019, in spite of the dip during COVID, has doubled to almost 2%, 1.9. In 2024 was 2.4%. And the number from Q3 suggests was almost 5%. And by the way, the Atlanta Fed no-cast for Q4 GDP as today is 5.1%. Probably it's too high. But given that one, given the job number, you'll have another high productivity growth. Now, I don't think the productivity growth is 4% or 5%, but there's definitely acceleration.
Jobs is key. Is it jobless growth? So-called jobless growth.
Yeah. Well, it's a jobless growth. There are three stories. One is that the GDP numbers are wrong, and the GDP numbers are going to be revised towards the weaker labor numbers. The other one is that, no, the GDP growth is strong, and you're going to have some adjustment upward of the revised data. I think the third explanation is the more correct one. You can have strong GDP growth and having weak labor growth because we're having a productivity revolution. If you're looking, for example, at the revenue, real revenue per worker of S&P 500 firms since the launch of ChatGPT in November 2022, the average has increased for S&P 500 firms by 15% in the last 3 years. So it's almost 5% per year. And if you look at it by sector, of course, a lot of it is closer to 20% in tech and communication services, but it's very large also across the board. So both at the micro data level, S&P 500 firms, and the macro number, we're seeing a productivity revolution already in the numbers.
I'm kind of dealing with whiplash right now because we just had the Rheinmetall CEO on, defense sector in Europe booming for all the wrong reasons. This idea that he's more worried about the state of the world than ever before. And here, Dr. Doom is coming on to tell us about how productivity boom is going to bring everything to a better place. Why are you less concerned about this overlay of rearmament and militarization that is also coming in tandem with this productivity boom?
Well, there are geopolitical risks in the world, and I'm aware of them. The question is whether they're going to have a significant economic and market effect. Look at the biggest one. You had the 12-day war between Israel and Iran last June. Oil price went up a little bit, stock markets wobbled. And then, given that Iran did not attack the oil facility of the Gulf or block the Strait of Hormuz, it went away. And that was a big deal. Venezuela, we can discuss it at length, but the macro and market implications are close to zero. It's just less than 1 million barrels a day. Russia, Ukraine is a mess, but it's not going to have an impact on global market economy the way it did in 2022. So, and US, China, they are, of course, in a competitive strategic competition, but right now the trade tension, for all the reasons we know, are somehow limited. So every time there is a geopolitical risk, people say, stuff could happen, but so far, those that we have seen in the last few decades, leaving aside the 70s with the shocks of Yom Kippur and the Islamic Revolution, have not a market effect.
Do you think, though, that the United States is going to lose some of its luster as an investment haven in terms of the ongoing conflict between the U.S. and traditional allies like Europe? I mean, have you seen anything like that, or do you think that's overstated and productivity really is going to rule the roost?
I've been saying since last year that tech trumps tariffs because I think that the upside coming from tech is 200 basis points. Well, if you add all the impacts of the bad stagflationary policies of Trump, trade, restrictions of migration, fiscal deficit trying to affect the independence of the Fed, rule of law, the maximum from an empirical point of view, it could be a negative 50 basis points downside to potential growth. So you have an upside of 200 from technology, you have a downside of 50, it's a ratio of 4-1. So tech trumps tariff. So the stuff that is technology is first order, everything else, including geopolitics, is second order.
Is this why the AI trade, the market pretty much shrugged off at independence yesterday as a serious concern?
I believe that there is some frothiness, of course, in the AI sector. But if you talk to all these companies, I think that they would all argue that we are maybe at worst 5 years away, or at best 3 years away from AGI, however you want to define it. Now, if we are achieving artificial general intelligence, the valuation of not every of the Max 7 is going to reach AGI, but maybe 3 or 4 will. So the value of a firm that's going to be having AGI is going to be 5x of its current value. So that's the race. So if you think of it this way, yeah, there is some frothiness. There can be a correction. But with US growth at 2% for the last few decades, the average return on S&P 500 was 12%, including dividends. Of NASDAQ was 16%, and was with 2%. Suppose growth is not 2, 3, let alone 3.5, 4. American exceptionalism has to become even stronger, because if it was American exceptionalism with 1.8% growth, with higher growth, it has to be better than that on average. Now, there'll be winners and losers, both within publicly traded firms, old economy versus new economy, and among the startups. Many of them are going to go bust. But if you're looking at the medium-term horizon, with higher growth, you're going to have higher returns. And we're seeing, based on the data on real revenue growth for S&P 500 firms, that most of those productivity gains are gotten by the firms. Real wages are growing less than productivity. Unit labor costs are falling. That's why there is malaise. That's why people are worrying about affordability. But from a profitability point of view, the corporate sector is doing great.